Hello, everybody. I've brought my handbag. Oh, let's bring our panel on, please. Fantastic. Have a seat. How are we all this morning? Good?
Big crowd.
Fantastic. We're going to have a proper. I feel like I'm going to have an intimate conversation with this mic in my face. Okay, right. Here we are. We're going to be talking about London's incubators, accelerators, these kinds of little sort of mini clusters, which are artificially created, artificially funded with money, but they're here and they're doing things with entrepreneurs, and it's happening. So we're going to do a little bit of an introduction, and we're going to talk about what are these organizations doing for startups, for technology companies. So just as a way of introduction, let's hear firstly to my left from Reshma Sohoni from Seedcamp. Now Seedcamp started in September 2007. I was there, and it was initially the backers of Seedcamp are venture capital funds and other kinds of organizations. Perhaps you'd like to just tell us briefly about what Seedcamp is.
Yeah, absolutely. So indeed, we began in 2007 as an accelerator and a seed fund. We had about 20 investors. We now have 40 investors, and they are corporate investors, so corporate VCs, venture capital firms as well, and a lot of angels spread well across Europe. We've backed now nearly 100 businesses, so we're definitely getting into sort of what is it all meaning and the success and so forth, and we have some great data around it. And we really help businesses both at the trying to find product market fit and at that stage onto companies who've done that and are actually just really wanting to accelerate growth and scale. So we really have offerings for both sets of startups.
Fantastic. And we're going to unpack about the differences between these organizations and how they operate. And then next, in a sort of historical journey, what happened a couple of years later is that we had the rise of other similar kinds of organizations, but doing things in a different kind of way. So next up was John Bradford over here. And John Bradford, initially, now we met, I think, first of all, in the north.
Middlesbrough.
The north, Middlesbrough.
Look it up on Wikipedia.
Fantastic.
It's grim
There
up north.
there is a real place.
Said the man from Belfast.
There is life north of London, exactly. And you were doing an incubator up there, and then you parlayed this into a new organisation called Springboard, and I can't believe, frankly, that you got springboard.com. I mean, I thought somebody would have taken that.
I have some very nice investors who've got very deep pockets.
And very friendly people. So, but, oh, God, I hate these fucking excuse me. Please do not swear or... So, John.
Hello.
Tell us about Springboard and why are you different to Seedcamp? Go.
Why are we different? We effectively run a 13-week boot camp as part of the process, and we never take more than 10 teams. We give them smaller amounts of equity initially. We have access to follow-on funds for the teams. It started all in Boulder in 2006 with TechStars, and the year earlier, which was Y Combinator, but it's essentially this idea of an intensive boot camp where you work with mentors on a day-to-day basis over that period.
Oh, I see. So you looked at the model, you looked at that.
I cloned it.
You cloned
I'm the rocket internet of accelerators.
You're Oliver Samware of the incubator space. So you did that, and then now you've been. But how many years has Springboard been? 2 years? 3 years?
So Difference Engine, which ran in the north, ran twice. Probably the most interesting one that came out of that is a good friend of ours, which is Bastian Lehman, who participated in that program. He tries to forget that memory. Who's gone on with Postmates to raise, I think, over $10 million, is now in the West Coast. That subsequently then morphed into Springboard, which is run 4 times. The demo days tomorrow. We're trying new and different things. We're doing hardware at the minute. And in about 3 or 4 weeks' time, TechStars London kicks off.
And now you've parlayed Springboard into a TechStars, official TechStars networked organisation, effectively.
Yep. So
TechStars, the rather well-known accelerator out of Boulder, Colorado, and then and they've also doing TechStars New York as well, right?
Yeah, there's 9 cities now.
9 cities, right? Yeah.
So I'm their rest of world strategy.
You're the rest of you're doing everything else.
I do.
And then now, a couple of years ago, when we had a new thing happening, a flowering of clusters in London, and Amy, you did Innovation Warehouse. So tell us about, is Innovation Warehouse an incubator? Is it an accelerator? How would you describe it?
Yeah, so it was more or less the same time as Tech Hub sort of came into being. There was not much else going on at that time. And so Innovation Warehouse is basically, it's a co-working space. It's a hub for people to come and work. So that's basically what it is. But the kind of people and the kind of companies that we look to attract are basically high growth startups who have aspirations to just be successful high growth startups. So that's kind of what happens. What goes on is it's led, rather than that being the business, it's led by a group of angels, of which I'm one. Since we started about 2 years ago, we've had about 200 companies come through. We've invested in, we've just done our 11th investment, so that's about 5% of the companies that come through get actually direct investment from the angels there. And we're just doing some research on this, but I think probably about 35% of the companies that come through there raise money as well. So they're in an environment that gives them access to capital, which is we all know the fuel for growth, part of the fuel for growth.
So it's a different kind of a take on things. We have a kind of an accelerator, we have a boot camp program, and we have a co-working space with angels attached and a network of people who can potentially invest. What do we think? Is there any particular model that you guys think works extremely well? I mean, obviously you would argue for your own models, but what's actually, what's the most effective? I mean, because also we've got to realise that it's fairly early in the game over here in Europe, and we've seen Y Combinator, for instance, do incredible things in the US. TechStars also did very well, but what are the models that work for this kind of thing? And is it something that works for Europe as well? What do you think?
Yeah, I mean, I think a couple of things on that. We morphed the model quite a bit for Europe. So again, we take a dual approach. Our program's 1 year long, really. So there is a 3-month intensive period where the companies that come in for trying to really determine product market fit we can really focus on that. And then the 9 months are all about acceleration and taking the companies into US, increasingly into Asia. So I mean, we've definitely had to learn and play around with the model a lot. And I think the second point is quality. I think any startups really wanting to apply to any of the places up here, or probably the 100 others that have mushroomed in the last few years in Europe. If you want to apply in Europe, really look at quality and what's coming out and who are the people involved. So I think that really separates. As you said, we could argue on our own model, but I mean, I think they're all different. They all work differently for different businesses, but there's some inherent quality here, and I think that separates from a lot of other names and who don't talk a lot about their successes.
Right.
The common theme across the board, and this is kind of one of those long-term themes, which is only going to become more important, is for the old farts in the room like me that were around in 2000. Capital was a barrier to entry. 10 years ago, 12 years ago, you had to raise $10 million to kind of just even get out on deck and actually just even being considered as a startup. The cost of capital has completely fallen through the floor. The ability to do startups has completely fallen through the floor. And actually, it's only going to get cheaper and cheaper to the point where it's now almost the marginal cost of just keeping yourself alive or a team alive. And so therefore, capital no longer becomes the barrier to entry. It's actually the smarts. It's the who do you know, the experience. How can you create an unfair advantage through the networks, through the knowledge, through the experience that actually will put you slightly ahead of the curve. And arguably, the people who have been doing this the best for the last 30 years is Silicon Valley. Yeah, we talk about it as being capital, but actually it's the close proximity of lots of very knowledgeable people close together. And each of us have a slightly different variant of that model, and we have different views about whether it works or it doesn't. But equally, the other side of that equation is different teams have different requirements. So it's not a competitive process in the sense that it's about you do one or the other. There could be times in the journey of your organization which is more appropriate to be at different stages.
Is there? Are we? No, I'm going to be devil's advocate here. That's my role. I mean, are we creating a sort of artificial environment? Are we sort of keeping some companies kind of on life support that shouldn't really exist because they're part of an incubator or an accelerator or whatever you do? Should they? Is that the case, or would some of these, if they were taken out of that environment, would they wither and die?
There's two parts to that. One is it's really competitive to get into our program or any, particularly Seedcamp and ourselves. And so therefore we have like less than a 1% selection process. So we're hoping we're not
100 applications, you only
we
select
had
one.
like 1,300 applications for 10 places. So unless I'm being a bloody idiot, hopefully I'm not picking stuff which is just barely alive. Yeah.
Right.
The other half of that, which is actually much more interesting to me, is your ability to take high-risk projects and actually say the potential of this project is really massive. And more often than not, you won't get funding because it's such a massive opportunity, but such a high risk. Through something like a 13-week accelerator, one can actually test those assumptions much, much more rapidly rather than spend 12 months being really drawn out about it and kill the project earlier if necessary.
But are you being too restrictive? I mean, for instance, at Innovation Warehouse, you have a more sort of a porous model, certainly people coming in and out, and you might, one day an entrepreneur might be hitting it out of the park one day, the next day, not so great. It depends on what's happening. I mean, what do you think it's better to be more flexible?
I can't say. I think there's room for many different ways of doing things. So horses for courses. Yes, our model is more porous. We get to know the people. It's very much about, particularly if you're going to invest, you want to know who you're investing in. It's very much about relationship. And there's no kind of artificial cohort. So it's not that a program starts and a program leaves. It's really about actually sort of working out where they're going and doing a lot of due diligence. I mean, I see an accelerator as it's a networking, it's an educational program. I kind of expect people, we don't provide education, we expect them to go and sort out their education. I think education is very good if you need to cover all the different bases, otherwise you can usually tap into it, gaps from somewhere in the community. So if a company's gone into Seedcamp, it says a lot because you kind of know they've got a future over there. Or if they go past the first two hurdles, then they really do have a very good future. If they come out of Springboard or TechStars, for me it's a kind of due diligence because if they were really crap, they probably wouldn't come out and they would have discovered that they should never have gone in.
So if you hit 90% funding post-program, that's probably okay.
Well, the question is, at the end of the day, we can only measure by annual rate of return. So, exiting from an accelerator, getting the next round of funding. To me, the only way of measuring this is actually to say, what was my annual rate of return? If I invested in this accelerator, I invested in this company, at the end of the day, across that portfolio, at the end of the day, what was my annual rate of return?
I think that's a fair point, right? I think the fact that we have high rates of companies getting to that next round of funding, that means we're high quality and doing our job very, very well. That doesn't say anything about the ultimate sort of success of the business. And fundraising is not the end goal, right? It's another, especially the next round is another way to get to your next sort of growth points and milestones and get your product into customers. So I think, you raise a fair point about sort of really focusing just on fundraising and raising your next rounds of capital. So you really have to look at longevity of the business.
I didn't want to talk about the end game until later, but as we're on the subject, exits. We've seen. One of the things about Silicon Valley is you have this ecosystem of acqui-hire, as it were. So in other words, somebody creates a company, they get traction, they build an amazing product, and there are firms there, there are companies that will literally just go, we need this team, bang, and they'll just buy that company. There's an exit there. There's a whole ecosystem of exits. We have different kinds of exits here. We're looking at perhaps not necessarily even exiting for quite some time, actually raising capital to build an ongoing business, a real business. And I think one of the interesting things about, for instance, Seedcamp had Rent Mine Online. Rent Mine Online was a company, and talking about the sharing economy, Rent Mine Online was quite literally, one of the earliest sharing economy companies. Literally rent my product, something that I've got in my house, a drill or something, and they did exit. But that process took a while, didn't it? So, where are we in the cycle? That is it going to take the next 5 years for some of these accelerator-driven companies to come out? What's happening?
Yeah, we're working on 2 exits right now of our companies that started, in that kind of 07, 09, 08, 09 time frame. But we've also had 2 bigger ones with MobClicks and Rent Mine Online that happened within 2 years and 4 years, which is incredible for kind of European started. Key thing is both of them moved to the Valley at some point, and both sold to American publicly traded businesses. So I don't think you can get away from that. And one of the things about
an exit is an exit. Doesn't matter where it is.
Absolutely. And one of the things we focus a lot on with the U.S., of course, on the fundraising side, and getting folks like kind of Redpoint and Union Square, Matrix, and those kinds of folks in our soft tech and so forth in our companies. But another is to really get our companies in the mindset of the Yahoos and the Googles and Amazons and so on and so forth. So what's changed a lot in the last 5 years is those the big players out there who are doing both acqui-hires to big acquisitions, is they're looking much more in Europe for a lot of different reasons, whether that's they've got a lot of money over here to be deployed, or they see incredible sort of talent to bring on into their teams, right? So that's been a massive change in the last few years, but we will only start to see the fruit of that probably going forward. And then so it does take longer over here, is our view.
What's your perspective, John?
So there's 2 parts to this process. We get a lot of data because in TechStars we now work with over 120 teams a year. And up to this point, I think we've invested, up to the end of 2012, we invested in 200 teams. The basic stat that we're seeing a lot is 10% of the teams exit within a couple of years. And because we can get in and we have only a seed round essentially during that 2-year period, effectively we'll pay for the whole portfolio. Anecdotally, and Reshma probably has insight into this as well, is there's what is discussed in the public domain in terms of what exits happen. There is a whole bunch of things which actually are happening behind the scenes, which are exits which are opportunistic, but don't happen. And I know even from the Springboard days, we've had opportunities to exit a team in the first program and a team in the second program, and both of those would have repaid the whole fund at that point in time. But the view was within the investor group that the opportunity which existed was a much, much bigger opportunity in the longer term. And typically that 2-year period tends to be the point where they're just about to go for a big Series A. And so therefore, and this is where access to the US capital is interesting, because when you're going for a Series A, the next thing you try and do is, if there's an interesting opportunity for an exit, that helps to drive a better valuation on the other side. So you can kind of use it as a broker to kind of keep the potential investor honest on the way through. So, but a lot of those things don't happen because you just go ahead and you go for a bigger round. So there's the untold stories of what exits are presented as an opportunity.
And did they? What happened with those teams then?
Both of them are doing multi-million-dollar Series A's, which will happen publicly in the next kind of 6 weeks.
Read about it on TechCrunch. What? But is there something about the accelerator environment that works particularly for Europe, because we have a difficult sort of a clustering environment, things are fragmented, or is it a case of, or are you guys sort of taking advantage of the market? You know, the fact that the entrepreneurs don't know where to go, and you're on stage at LeWeb, nobody knows where to go. What happens?
All of the above.
What do you think?
I think both of you have said a lot about exits, but I think there's something else that is happening, and there's a whole kind of that is being led by this as a kind of byproduct, which is the sort of whole entrepreneurial sharing community, and it's being led by, okay, maybe I want to get an exit on NASDAQ, or I want to, huge acquisition or whatever. But there's a byproduct that is actually a lot of people are doing their own thing. They're building companies. And actually, for a lot of these companies, they're not going to be exits, but they're going to be good companies. They're going to be good, sustainable companies. They're going to employ people. And it's going to be very good for the economy. So actually, there's a fantastic byproduct for the economy that's happening here. And of course, we want to attract, and we all want to find those very high growth, very high potential ones. But there's a lot of other stuff going on, and there are a lot of things that are still broken. Because if you're an angel and you find a good opportunity, and it turns out to be a sustainable, growing, healthy business, you're never going to get your money back. So
right.
there are some
never
things
going to get your money out.
You'll never get any money out of it, because there's no sort of massive exponential.
So what's the incentive to invest?
I think a lot of people actually people actually invest. Angels tend to invest because they enjoy it, because they like the relationships, they like the people, they have fun. It's a bit like horse racing. It's a kind of hobby, and it's
a bet.
Yeah, because the thing is, if you want to really make money, there are other ways of investing your money, even gambling your money, and you don't have to wait 10 years to find out. You can put money on derivatives, options, and every day you can actually realize your benefit, or you can lose it. So it's not about just the bottom line, because it's a very, very long and hard road to hit that bottom line. So people do it because they enjoy it.
But to answer your question, mini Seedcamps, acceleration programs, meetups. Yes, we are creating artificial environments, but we are bringing people together to create this idea of serendipity, of actually putting smart people in a room together. Some of them are ready for investment, some of them may do accelerators, some may be still really early in the process. But where you can start to create a peer-to-peer exchange of information, that's where this all becomes really interesting. And essentially, all of the formats that you described here and across Europe, that's what's interesting, because we don't have the capital, so we have to use the know-how and the knowledge and the experience to help pump prime the system.
The network is sort of in operation. If I was a skeptic and I would say, you look at some of the biggest companies that have been created over the last couple of years, they weren't necessarily created out of accelerators. They were created out of an entrepreneur in their back bedroom coding something, picking something up. We look at something like Nick Delasio from Sumley, 17-year-old coding something in his holiday period, his vacation, in spring break, basically from school, and exits to Yahoo for $30 million. He didn't go through an accelerator program, did he?
There's a really interesting question in this, and it's something that a lot of people smarter people in accelerators are thinking about, is would Mark Zuckerberg have done Y Combinator or TechStars or Seedcamp? And actually the general consensus is the answer is no. Yeah? And the question is, is that wrong or right for us? Part one. And part two, what would we have to do as an organization to make it appealing to participate in those? Or part three, he would just never do it anyway because he's such a stubborn, pig-headed entrepreneur. In his
Doesn't want to take advice from John Bradford or Reshma, Sohoni, or they don't care.
And there's somebody said to me recently, there's a really famous video of him talking about Facebook really, really early, and somebody was trying to give him advice about why don't you think about this, or what about this opportunity? He was, no, I'm going to do it this way. I'm going to do it this way. So he would have he's like, would Steve Jobs have done an accelerator and taken mentoring advice?
Might have been tough with Steve Jobs, yes.
I think those are the exceptions, though, not the rules. So
They're big exceptions.
Yeah, so you can't really. I think are more people getting the opportunity to build a business and build a high growth business because of accelerators? And I would definitely hope the answer is yes. That should definitely be yes. Can I say something else about the funding as well? Because I had a conversation about this yesterday, and in terms of what's going on in the London tech scene, and we likened it to a kind of market or bazaar or souk outside the city walls. So, when you're talking about exits and acquisitions, we've got the City of London sitting there on a pile of money, but none of it actually finding its way to fuel what's going on just outside. And that's the kind of thing that we need to kind of change.
That's a good point. Let's talk a little bit, because this panel was built a little bit closer to the London scene. Where are we in London right now? So we've got Google campuses. Google took out a 10-year lease on a building. You guys have just moved into a building in Clerkenwell. Your teams are spread all over the place, partly in Google campus, partly
in Warner Yard as
in
well.
Other places. You've got your own space in Spitalfields.
Smithfields,
right?
We've just opened in Portsmouth as well.
Just opened in Portsmouth. There you go.
Centre of the tech scene in Europe.
You
heard it here first.
Low capital outlay. What's happening with the cluster right now? Is it good times? Is it boom times? What's happening? Sounds pretty boomy, actually.
I think it's really boomy because I'm actually seeing bad teams getting funded.
You're seeing shit companies
getting funded.
But I think, the problem.
It's a bubble.
The problem, we were the first to market back in 2007. The problem we set out to fix is essentially pretty fixed, right? The 50,000 euros, the kind of 100,000 euros is a pretty fixed problem. It's not fixed to a high quality extent. There is a lot of quantity, right? So, but what is still not fixed is trying to raise sort of 250K to $1 million. There's again a huge pool of capital. But we're seeing a big problem is no leaders.
We have a Series A crunch of our own.
It's not even so much, not from as much a capital standpoint as a leadership standpoint. So a lot of the city angels or angels kind of spread around, or new angels because of the EIS, SEIS, are all willing to put 50 or 100K together, but no one's willing to take leadership to actually work with the business. And that's a real problem we're seeing. So the boom is great because the availability of capital has just, grown exponentially, but the problems for really growing these businesses still exist. And the biggest one is the lack of leadership.
So this new sort of tax incentive by the UK government, SEIS, these kind of schemes which incentivize people to become angels. They're not necessarily from the tech community at all. They're wealthy people and they've got some money to invest. That's bringing new flood of new money. But then, as you say, you've got institutional investors who aren't necessarily punching up to like a Series A round. Why is that then? And I thought that we had a whole bunch of new sort of funds turning up, Passion Capital, EC1 Capital,
they're seed funds.
Capital.
They're seed funds. They're not A-round funds.
Right.
So their business model is get in early, take high risks,
So is there
invest relatively small sums
so
of money. and
So are
take
you
a-
saying therefore that the Index Ventures, the Axel, the
four.
Bulletins,
There's 4. Yeah.
It's 4, and actually,
Four.
Atomico
Wellingtons,
are like, unless you're making
Atomico.
$1 zillion a year,
yeah,
they just don't
There's-
even look
there
at
are
you.
4.
There's 3
There's only
actually
4.
active.
Yeah.
in London, and that's a sort of pan-European
The
kind of
only
sense.
one that I've seen which is unusual is I think Sunstone with Max's move,
Max Niederhoff.
interesting out of Axel, could actually create potentially another player in that space. But there's essentially, having said that, the metrics, when you look at the European metrics, the metrics in Europe are not dissimilar to the US. It's about 1 in 3 teams go from a seed round to an institutional round. The difference is there's 5 times more capital in the US than there is in Europe. So whilst the percentages kind of are comparable, there's just the sheer quantum of capital that is available in the US means that if you're on the top part of the pile, there's a greater potential that you're going to get
Reshma,
funded.
you said something earlier about some companies like Mobclicks and others going over to the US and then raising bigger rounds and over there. Can we attract some of that capital over here? And I think one of the interesting things is because you guys are creating these great clusters for investors, you're doing the due diligence, you're sorting the wheat from the chaff, you're making it easier for these guys to come in on a plane from SF or from New York and go, right, what have you got? What are we going to do?
Exactly.
Is that going to work?
Yeah, I mean, the reason we started the U.S. trips, we learned it a little bit just by chance. So I happened to be in New York on vacation, and I met up with Fred Wilson, and I said, hey, there's a company that's so cool, and you blog a lot. It's called Zemanta. And he looked at me and he said, this is the third time I'm hearing about this, right? So it sort of started on a vacation, and he then ended up coming to Slovenia and visiting and loved the team and invested in them, right? So
Fred Wilson in Slovenia.
Exactly. So that was sort of by chance. Kind of couple more things like that started happening, and we said, actually, we should take our companies over there, start to really get American investors to see what the quality of what we're bringing on, and the best of the best, and they'll start to come over here as well. And what we've seen a lot with our companies is not just either they move to the U.S. and that's it, but a real kind of collaboration between European investors and U.S. investors to come into rounds together. So, if you pick up the Informalo newsletter, TransferWise is one of those businesses that has raised a little over $7 million in capital. Their most recent round has Peter Thiel in the West Coast, IA Ventures in New York, Index in London, Seedcamp in London. So, completely really global, and actually some interested investors in Asia as well. So we're really trying to ensure European capital, European startups, are connected, and it's not about just sort of throwing in the towel, moving out to the U.S. And it's happening. So that's just one example, but. Farmeron sitting in Croatia, his investors again, and he's not even in London, but Croatia, his investors again are California, Boston, London. So Farmeron, check this, Uberview, Zemanta, Erply, TransferWise. I mean, it's a lot of names that we're seeing more and more. So it's extremely exciting.
Do we see that that's going to happen more and more? As the Valley is very, very expensive now. I mean. CTO is $100,000.
But TechStars is a representation of that.
Off.
TechStars are a US venture capitalist. We have $70 million under management, and they've moved to the UK. That says something about what's happening in the market. We're going to deploy, just out of our own funds, something like $4 million through, and all of that funding is coming from the US. For the teams that participate in London and when they are physically in London.
Saying there's a sort of a flight of capital
it's
out
moving.
From very high cost.
I think Seedcamp have done a great job, and part of the process of them spending more time in the US and raising awareness of European teams in the American markets made a real impact.
Can we go?
But
the other way?
This is the other way.
Can we go to Asia? Can we go to emerging markets like Africa or India?
I think it's a combination of two things. I tend to be a strong believer in that money flows in the markets that they want to be in. So if you take Huddle, for example, when they went to the US, they raised US investment. The risk of moving into other markets is unless you have a very sizable investor behind you who's taking a much wider play, it's really difficult to say, I'm going to Singapore, and an EC1 in the corner is saying, hold on a sec, but we've paid for you to fund here in London.
Very small seed fund.
But nonetheless, you tend to find that European investors will invest because they want to see European expansion, and they will probably allow you to play on the edge, but it doesn't. They don't write checks to say, and go to Russia, please.
I guess
There'll be a Russian.
Atomico is different, right? And Atomico does really look at global. I think that is the way more European investors need to think, though, right? Is to be much more embracing about your companies finding the right market. I mean, one of our examples is BaseKit, funded by Nauta Capital in Spain and Eden, out of London. Their biggest markets are LATAM, India, Asia, and great by the investors to not try to pigeonhole them here and to say that's where you're growing, go for it, right? And really kind of
they're not trying to shoehorn them. You must be big
exactly,
in
but
this
but
bit,
that's
area.
I mean again that's like Atomico, it's a handful of names. Again, probably on one hand, a lot of the European investors we see again really just try to pull the company, really pull them to stay.
Last question. Good point. Last question. You're in London. You're in London. Why are you in London? Why are you not in Paris or Stockholm or where? Why?
Yet.
I love
yet. Oh, watch this space.
I'm in London because, apart from the fact I love London, apart from the weather, I think what we've seen happening here is probably something similar to what happened in New York. It's a really great time. We see things starting to get connected. So you've been doing it since 2006 or 2007, and there was open coffee, and that was just about the only thing that was going on in London. And now I think some done research. At every moment of every single day, there's about 10 different places that you could be. So it's massive what's happened in London. The other thing is, we talk about Tech City, but actually London is in itself is a huge brand, and there is so much going on here. There's so much potential. There's so many resources. There's so much talent that this is a very good place to be.
It's Judge Dredd's megapolis. We have tiny bit of time for quick Q&A. If anybody would like to do some questions, if you have a point. Now, I'm not sure if we're not really set up for this, but I'm going to steal a microphone, thank you, and do my sort of talk show host thing here. Let's go and if you could just tell us, I'll do this. Who are you?
All right, so I'm David from PiggyBee,
Okay.
and we do parcels shipment by travelers.
And what's your question?
So I'll get it.
Go.
Have you packed it?
All right, we're at LeWeb. The theme is the sharing economy, and I would like to get your position regarding the sharing economy. I mean, talking about Airbnb and Y Combinator, what's your vision, and are you scared of it, or?
Okay. What about, there's a lot of startups out there doing these kinds of sharing economy startups. Is the bubble bursting, or what do you think?
I think it's a great term for something that's been happening for many years, right? And so Rent Mine Online tried to do that. They eventually moved a little bit, but in 2007 you didn't have sort of the tools that you do today to be able to really make that happen.
You didn't really have social.
Yeah, and I think the sharing economy really is. Max Levchin said this at DLD in January, and I think it's it's perfect. It's capacity utilization, right? The internet allows you to reach more and more units of resource can reach 100% capacity utilization. So that's exciting, and we should, in terms of sort of efficiency and value for money, that's exciting to be a part of. So we absolutely love it and excited by it, and I think it's about finding the right models and the right entrepreneurs to back. But the idea of 100% capacity utilization is fascinating.
Yeah, I totally agree with that, and I totally not afraid of it at all. Absolutely embrace it 100%. Another thing we were talking about the other day is and this is about the souk and the outside the city walls, what's going on in the city. Actually, why Do you need a 70-story building or a 30-story building in order to pass money from one person to another? So those are the places that need to...
You're talking about, like, what, a bank, you mean?
A bank, yeah.
Right.
So, you know, and also, you know, I mean, even if you look at the sort of traditional VC model, if you look at what's happening at our crowd, which admittedly is just beginning in Israel, but that will also flow. So you're seeing the kind of VC level of investment also being done in a sharing economy kind of way. So I think it's great because it's just creating so much opportunity, and it's a great time to be doing this.
So there's a nice writing up by Martin about Fawn, which started 5 or 6 years ago. Yeah. About this, and so he's been doing sharing for 5-6 years now. I think what I find really fascinating is the intersection between the sharing economy and hardware devices. Because at the minute, Fawn, for example, is you opt into that community. When you can actually string communities together and you actually don't have the optionality and everybody's part of a collective system, your ability to manage the underlying capacity constraints is really, really interesting because you can increase the underlying capacity utilization and productivity of assets without necessarily having to grow the underlying asset base at the same time. And so governments are really looking at this stuff really, really carefully. So I think it spans both private and public as well.
Fantastic. Well, we're actually now out of time, and I don't want to take away time from the next session. So I want to say thank you to our panel, and obviously thank you very much to the sharing economy for bringing us here. Thank you very much, everyone. Cheers.